Right, well, welcome to our final webinar for the spring season. So a couple of interesting sessions today. My name is Chris Holmes. I'm one of the consultants on the Tax Support Professionals Helpline. Our various speakers today are, for quick news, we're having Sadiq and Marv, also consultants. Paul is then doing a session about alternatives to trust, and then Gemma and Nick are doing a question on valuations. Next slide, please. Right, so yeah, so this is the agenda. You'll notice the trust, looking at various options like fixed growth shares and direct gifts. And then we've got the valuation. It's a bit, our valuation session here is slightly different to usual because usually Diane, who most of our clients know, comes in and talks about valuations for tax. Today, Gemma and Nick are actually going to talk about valuations for accounting purposes. So a slightly different spin on our usual valuations presentations. So hopefully you'll find that interesting. So right, I should say, if you've got any questions, if you just open the Q&A box and put them in, there are things at the end of each session, and I'll read the questions out to the speakers at the time. So when you think of questions, just put them in the chat. Just put them in the Q&A section. Next slide, please. Right, over to Sadiq then to start hot news.
Thank you, Chris. So if we go on to the next slide, I just want to discuss two recent developments in tax, which are quite important for us. The first one's to do with the mandatory payrolling of benefits. Now, these rules, the requirement was supposed to come in on 6 April 2026, but it got further delayed by a year to April 2027. So this is the requirement for mandatory reporting and paying of income tax and Class 1A national insurance contributions on benefit in kind using payroll software. So HMRC is saying that they're providing more time for employers, payroll professionals, software providers, tax agents, and other stakeholders to prepare for the change. And Caroline Harwood from BDO's National Head of Employment Tax is saying this is good news and it'll give employers more chance to get used to the softwares, which BDO's got a really good P11D software, which you can check out on our website. The second big news is to do with the transfer pricing consultation. Now, this is a consultation which is open till 7th July, and it introduces some changes to the current transfer pricing rules and diverted profit tax rules and permanent establishment rules. So I'm just going to cover two of the big changes here, but have a look at the consultation. It's really interesting. So one of the big changes is to do with UK to UK company transactions. Now, previously, Chris Holmes, the presenter here, would have discussed this in the last month's TSP webinar, where he's talking about transfers of stock and fixed assets between UK to UK companies. They previously used to have to apply transfer pricing rules if they were a large company. But now the government's saying in this consultation that transfer pricing is not going to apply to UK. And this kind of makes sense because since Brexit, the government is comfortable in most related party transactions within the UK. So that means they no longer have to account for tax under the arm's length principle. And it's going to be a lot less compliance when it comes to UK transactions. So that's a big change. The other big change is to do with the SME exemption. So currently, small and medium-sized enterprises are exempt from UK transfer pricing, other than transactions with in certain territories and in situations where HMRC issue a discretion, which is seen a lot less these days. So what is an SME for transfer pricing purposes? Well, the first test is to do with the number of staff you have. So if you have less than 50 staff, you're a small enterprise, and then you have to have less than 10 million annual turnover in euros, or have a balance sheet of less than 10 million. And to be a medium-sized enterprise, you have to be bigger than a small enterprise, but have maximum number of staff of 250 and a 50 million turnover. So if you fall within definition of SME, you used to be exempt from the transfer pricing rules. Now what's happening is the SME exemption is being lifted. So small companies are totally outside of the transfer pricing rules, but medium-sized enterprises are within the transfer pricing rules. So if you've got a UK medium-sized company in a group, and they're selling abroad, they have to apply transfer pricing now. But remember, UK to UK companies is going to be exempt from transfer pricing. And remember, with transfer pricing, you're looking at the size of the group in total. So you're not looking at the standalone company, you're looking at the whole group. So that's just a summary of the consultation on transfer pricing and mandatory payrolling of benefits being delayed by 1 year. And that's the end of direct tax news. So I'll hand over to Marvin to talk about indirect taxes.
Hey, yeah. Well, thank you, Sadiq, and good afternoon, everybody. I'm first going to talk about VAT in the care sector. So over the last couple of weeks, HMRC have issued Revenue and Customs Brief 2 of 2025 and Spotlight 70, in which they confirm their view that certain VAT planning in the care industry constitutes tax avoidance. So usually the provision of welfare services by a state-regulated body in a care home would be VAT exempt. So that means that the provider would be unable to reclaim any VAT that it incurs on associated costs. Broadly speaking, the arrangements that HMRC are referring to involves a care provider setting up an unregulated entity that would enter into contracts with local authorities in the NHS to provide the care services. As this entity is not state regulated, the intention is that the VAT exemption would not apply, and the relevant services would then be standard rated. And there are special rules that would enable the local authorities and the NHS to be able to reclaim the VAT charge to them. The existing regulated provider continues to be the contracting party to self-payers, so the VAT exemption continues to be applied to them. The planning relies on VAT grouping the unregulated entity with the existing care provider, and any supplies by the care provider to the unregulated entity of staff who would actually be providing the care will be disregarded as a consequence of the VAT grouping rules. As the VAT group will be making VATable supplies to local authorities in the NHS, this secures additional VAT recovery for the VAT group on costs that would otherwise not be recoverable. The planning's been on HMRC's radar for some time, but up until now, HMRC has not published its views on the arrangements. They now say that these VAT grouping structures are artificial and contrived, and as such are a form of tax avoidance. HMRC will say that they'll take action with immediate effect to prevent the use of such arrangements going forward. Firstly, HMRC say that they'll refuse new VAT group registration applications that are designed to implement and facilitate the structures. As regards existing VAT groups, HMRC have advised that they'll launch a programme to review and investigate all instances where it's known or suspected that an avoidance scheme is in operation. During the review, HMRC will assess each case individually and, where necessary, will exercise protection of the revenue powers to remove the relevant parties from VAT groups. However, HMRC have confirmed that removing companies from a VAT group can only have prospective effect. So it looks like no retrospective action would be taken in respect of any historic VAT savings subject to correct implementation. HMRC also advised that if organisations are involved in tax avoidance schemes, they will fully investigate their tax affairs and may treat the organisation as a high-risk taxpayer. So this means HMRC will closely inspect all the tax affairs in future, not just those in respect to this particular scheme. To summarise, it seems to have taken HMRC some time to conclude that these arrangements are avoidance, but they've now clearly set out the action that will be taken to stop this going forward. There's still lots of unanswered questions, such as what happens if the unregulated entity is removed from a VAT group? Can it continue to make standard rated supplies under a standalone VAT registration and secure VAT recovery on its own costs? Also, what will be the VAT treatment of any supplies of staff made by the care provider to the unregulated entity? No doubt it'll take some time for all these matters to be resolved. So if you've got any clients in this sector, this should be looked at as soon as possible to determine the impact of any VAT grouping changes. Moving on now to a couple of proposed changes that were announced by HMRC on the 28th of April as part of their spring tax update. This includes a package of measures intended to support the government's ambition to simplify and modernise the tax system. Firstly, there'll be a change to the Capital Goods Scheme, or CGS. So the CGS is a scheme under which it's necessary to monitor the use of certain capital assets that have been purchased over an adjustment period. So 10 years for land and buildings and 5 years for computer equipment. If the use of the assets changes during this adjustment period, the initial VAT recovery would need to be adjusted. So for example, where the exempt use of the asset increases compared with the use when the costs were incurred and the VAT was reclaimed, it may be necessary to repay a proportion of the input VAT reclaimed back to HMRC. But if the VATable use increases, it will be possible to seek additional VAT recovery from HMRC. Currently, the threshold for land and buildings to fall within the CGS is £250,000. So if the capital expenditure exceeds this amount, the CGS will be applicable. This amount has remained unchanged since 1990, and there have been calls for the threshold to be increased for some time. HMRC has now said that they'll simplify the CGS by increasing the threshold for land from £250,000 to £600,000. In addition, they'll completely remove computers from the assets covered by the scheme. As a consequence, this will reduce the number of capital assets that will fall within the CGS, reducing admin burden on businesses. There's no set date, but we would expect the changes to be introduced in a future finance bill after a period of consultation as to how certain matters should be dealt with. For instance, the transition from the £250,000 to £600,000 threshold may be quite complex as regards timing. And also a number of VAT avoidance measures rely on expenditure falling within the CGS, such as the disapplication of the option to tax rules. So we'd expect HMRC to consider changing the triggers for these anti-avoidance measures to prevent certain assets no longer being caught. The second announcement of interest is a proposed extension of zero rating that applies to the donation of goods to charities. So HMRC has announced a consultation that closes on the 21st of July, seeking views on a new VAT relief. At the moment, zero rating only applies to goods donated to charity that are going to be used for sale, export, or letting. So, for example, this might be excess stock that's given to a charity for the charity to sell in its shops. However, if a business donates goods for any other purpose, including for the charity to give away free of charge or for use in its own activities, the donor business must pay VAT to HMRC on those goods if it had recovered any VAT on their purchase. So effectively, the business had to charge itself output VAT on giving away assets of the business, usually by reference to the value of the goods at the time of donation. The new proposed relief would enable zero rating to also apply to these goods that will currently be subject to such a VAT charge. And this is part of the government's overall aim to prevent undue wastage of various goods and assets. Such relief will be welcomed, and as with the CGS changes, we'd expect this to be introduced in a future finance bill. The current consultation is looking at points such as whether a monetary limit should be imposed, whether certain higher value items such as laptops and mobile phones should be excluded, and whether there should be restrictions on how the charity uses the items. This is all with a view to preventing possible abuse of the new relief. The next point relates to the domestic reverse charge for construction services, or DRC, which has been in place since March 21. This applies where relevant services that are reportable for construction industry scheme purposes are supplied, and it shifts the VAT accounting obligation from the supplier to the customer. So instead of the supplier charging VAT on its invoices as normal, the customer accounts for the output VAT by applying a reverse charge and reclaims the relevant amount of input VAT on its own VAT return. There are certain exceptions, such as where a supply is made to an end user, which is a customer that will not be making an onward supply for the relevant services, and the supplier would charge VAT as normal to the end user as long as the customer notifies its end user status in writing. One problem has been there's been very little in the way of guidance, apart from a technical guide that was first published in September 2020 and was updated by HMRC in November 22. And there's various pages on their website as well that summarise when the provisions apply. And the main problem with the technical guidance is that it was incomplete. It was quite misleading in certain areas, and it was also unclear as to when HMRC would seek to take action. So what HMRC have now done is to create a new internal manual referred to as VAT RevCon, and this manual covers the DRC and it supplements the existing guidance that's on its website. This is good news because it goes into quite a bit more technical detail and is a useful resource when advising on the application of the DRC. So, for example, the new manual includes guidance for HMRC officers as to when they should consider raising assessments. For instance, where there's been a failure to correctly notify end user status. And it seems as though the approach would be to look at whether there's been a tax loss arising from the VAT accounting that's been applied, rather than taking a very strict way of looking at things and raising assessments when perhaps it wouldn't be appropriate. And finally, just a quick mention of an update to HMRC's online VAT registration application system. We understand from messages on the system that it's being updated on the 19th of May. And the message is saying that if an application is in draft on the system at the time of the update, it'll be deleted. And so it'll be necessary to start the application again. So if you have any applications in draft, it'd be worth submitting by the 19th of May, if possible, to prevent it being lost. Okay, so that's me. So next slide, please.
Thank you very much. Seems that Paul, our next speaker, is having difficulties getting in. So can we jump straight to Gemma and Nick, and we'll see if to their slides. If he doesn't make it in, I will run his slides because I know the topics. Right. So over to Gemma and Nick, and thank you very much for joining us.
Great. Thanks, Chris. Good afternoon. It's great to be here today to talk to you about valuations required for financial reporting purposes. I'm Gemma Flanagan, and I'm a director in the valuations team here in our London office. By way of introduction, I've been here with BDO for 20 years, initially in our audit stream, before moving over to valuations a number of years ago. And in terms of our session today, I'll give you a bit of context about our team before moving into the importance of valuations in a financial reporting context. So we'll think about why they matter, noting that multiple stakeholders make critical decisions based on the financial information reported in a set of accounts. In today's economic climate, stakeholders are demanding greater transparency and regulatory scrutiny is increased. So financial reporting valuations are technically demanding, they're time consuming, and they need to stand up to both auditor and regulator scrutiny. We'll look at some scenarios that typically trigger the requirement for a financial reporting valuation, such as changes in market conditions or company performance. And then Nick will take you into a bit more detail on 3 of the common financial reporting valuations that we typically see: impairment reviews, purchase price allocations, and share-based payments. We'll conclude our session by looking at some of the practical challenges, including limited data and choosing appropriate valuation methods, some key things to talk to your clients about, and a couple of real-life examples. Next slide, please. So a bit about our team. I know you know Diane on the tax valuations side of things, but we're a team of over 100 individuals based primarily in the UK, but also a team in South Africa. And the work that we do in the valuations team here at BDO is a mix of valuation services for our external clients, as well as acting as an auditor's internal expert for our audit teams. So as you can see from the slide here, the external services that we offer cover valuations for a variety of purposes, including tax, as you know, but also for financial reporting, for commercial and for dispute purposes. And then within the team, we do also have a team of real estate valuers. On the financial reporting side of things, it's here that we provide valuations that will end up in a set of financial statements and that will be audited. So our work here is predominantly focused on valuations for the purposes of IFRS 3, purchase price allocations and business combinations, investments, IFRS 13, IFRS 2, share-based payments, impairment reviews, IAS 36, and IFRS 16, incremental borrowing rates, or the UK GAAP equivalents. And we'll come on to those in a bit more detail during our session. And then where we act as auditor's expert, that's effectively the opposite side of the financial reporting valuation services we provide for our external clients. So that's where we're reviewing work performed by either management or another valuation provider as part of an audit. Next slide, please. So just setting the scene in terms of preparing a valuation, there's a really interesting article by Professor Damodaran, who is a leading valuation professor, who has a quite thought-provoking perspective on this, saying that valuation isn't a science and it's not an art, rather it's a craft. And why is that? So whilst we have formulas and models that help us with performing valuations, judgment is still required, and that judgment really comes from time and from experience. It's not just about plugging numbers into Excel and coming up with a number at the end of it. It's thinking about that context, the circumstances, the business or the subject of the valuation, risk, growth, business drivers. There's so much that goes into it. And that's really important when it comes to accounting valuations, where that fair value needs to reflect economic reality, as well as comply with financial reporting standards and withstand auditor and regulator scrutiny. Next slide, please. And so this slide just really re-emphasizes that point. Ultimately, the business world depends on reliable financial information. So valuations are crucial in financial reporting, not just for transparency, but for decision making. So they're triggered by events like business combinations, signs of impairment and changes in market conditions or business performance, issuing share-based compensation and incentive schemes or restructuring. Auditors and regulators expect robust, defendable valuations. So coming back to my earlier point, financial reporting valuations are technically demanding. They do take time and they really must stand up to that scrutiny. Getting it right serves the public interest. Getting it wrong can really undermine trust. Next slide, please. So here we summarise some of the key triggers that, and events at which point valuations might be required for financial reporting purposes. So the first 2 points on the left side there are both impairment related, either a mandatory annual trigger or where there's an indicator of impairment. In terms of the annual trigger, under IFRS, goodwill and indefinite life assets aren't amortized. So regular impairment, annual impairment review, make sure that those assets remain recoverable and that the carrying value in the financial statements is appropriate. For other intangibles or goodwill under FRS 102, a company needs to look at whether there are indicators of impairment at the reporting date and perform an impairment test if such indicators exist. So those indicators might include, but aren't limited to, things like declining market value of an asset or a cash generating unit, adverse changes in economic, legal, or the technological environment, underperformance relative to expectations or budgets, or market factors like increases in interest rates or other market-driven cost of capital changes. Another key trigger for a financial reporting valuation is following a business combination. So under IFRS 3 and FRS 102 section 19, where a business is acquired, the acquirer needs to look at the identifiable assets and liabilities and report those at fair value at the acquisition date. And that involves looking at not only the tangible assets, but also the intangible ones that perhaps haven't been recognised on a balance sheet previously. So things like customer relationships, trademarks are common ones there as well. Also technology. And then the excess of consideration over the fair value of the assets acquired is then any residual goodwill. Share-based payments is another key trigger. So again, under IFRS 2 and FRS 102 section 26, share-based payment transactions need to be measured at fair value at the grant date. And that fair value is generally determined using a valuation model. It might be Black-Scholes or Monte Carlo as an example. And that valuation needs to consider vesting conditions, both market and non-market conditions. Leases is another key trigger. So that's particularly looking at the incremental borrowing rate. One point to flag on leases is the upcoming amendments to FRS 102. So those amendments take effect for accounting periods beginning on or after the 1st of January 2026. And those are the most significant changes to the standard since it was introduced in 2015. They bring UK financial reporting more in line with IFRS, and a big change there relates to leases, and it will effectively align those accounting requirements and bring the majority of leases onto the balance sheet. Finally, just the investments held at fair value. So again, It's that fair value point where remeasurement is required, and that fair value needs to be reflected on the balance sheet. So I'll hand over now to Nick to explore 3 of those key areas in a little bit more detail.
Good afternoon, everyone. So my name is Nick Garish. I'm an associate director in the valuation team, and I've been there for 10 years, so not quite 20 years as Gemma, but getting there. I'm going to talk about 3 main areas of financial reporting valuations. So impairment reviews, purchase price allocations, and share-based payments. So you see on the slide, we're going to talk about impairments. So what is IAS 36 or the UK GAAP equivalent? IAS 36 governs the impairment of assets. It ensures that the company's assets are not carried at more than their recoverable amount. An impairment loss must be recognised when that recoverable amount for the asset falls below the carrying amount. As Gemma highlighted earlier, goodwill impairments for UK GAAP purposes are only carried out when there are indications of impairment, like a decline in the market value or poor performance or significant adverse changes. Under IFRS, these tests are mandatory on an annual basis, even without those indicators. So for assets like goodwill or indefinite live intangible assets. So some of the key concepts here is the recoverable amount. So when we look at the recoverable amount, it's the higher of the fair value less cost to dispose, i.e. what you get from selling that asset in an orderly transaction. And then secondly, the value in use. The value in use is the present value of future cash flows expected from that asset. And we will look at the mechanics of those calculations, including the discount rate as well. Those amounts are effectively compared to your asset carrying value in the financial statements. If individual asset impairment is not possible, then those assets are essentially grouped together in things called cash generating units, which are the smallest group of assets that generate cash flows independently. And goodwill is always tested at a CGU level. So why does this matter? So IAS 36 protects the financial statements by ensuring those assets aren't overstated. It's essentially critical in those market conditions when you have downturns and market conditions shift significantly. Go to the next slide, please. So moving on to purchase price allocations. So a PPA is a process of allocating the total purchase consideration of an acquired business to the identifiable assets and liabilities at their fair value at the acquisition date. And why is this done? So when a company acquires another business, the amount paid is often different to the net book value of the target assets. So under IFRS and UK GAAP, it's a requirement that the buyer has to identify those tangible assets and intangible assets like customer relationships and trademarks, liabilities, and also any goodwill arising from that transaction. So the process of the PPA is to first look at the total consideration, look up the makeup of that total consideration. So is there a cash payment, or is there equity being issued? Is there any deferred or contingent consideration based on future financial metrics, and also the assumed liabilities? Then it's a case of looking at the fair value of those identifiable assets and liabilities, and using techniques such as a DCF or market approaches in order to fair value those assets. And any remaining amount is booked as goodwill. So there's two primary methodologies that we would tend to use for valuing intangible assets. So you have the relief from royalty method, and this is used to value intangible assets like trademarks or patents. And it's by estimating the royalties a company saves by owning the asset rather than leasing it out. So it assumes that the company avoids paying a market-based royalty rate on that asset. Then secondly, we tend to use the multi-period excess earnings model. So this is used to value the primary asset. And it's usually the income generating asset like a customer relationship or technology. This model essentially calculates the residual cash flows attributable to that subject intangible asset, deducting returns for contributory asset charges. So these contributory asset charges are effectively renting out other assets within the business to support those underlying cash flows. And this can be in the form of working capital, fixed assets, other intangible assets, and also workforce. So one of the most technical aspects of the PPA is identifying and valuing those intangible assets that were previously not recognized on the seller's balance sheet. For example, customer contracts, technology, brands, or even in some instances, non-compete agreements. So if you have a situation where your purchase price is in excess of those fair value, the fair value of those net assets, inclusive of those recognized intangible assets, then the difference is recorded as goodwill. If the purchase consideration is less than the fair value of those net assets, then we have something called a bargain purchase gain, which is quite unusual to see and requires careful reassessment of those assumptions. So why does this all matter? So PPAs affect future impairment testing, particularly for the goodwill figure, and also for tax planning. It also provides transparency to investors to show what the buyer has reflected in their fair value of their assets and liabilities. We can move to the next slide. Now coming on to share-based payments. So this is under IFRS 2 and also UK GAAP. IFRS 2 deals with the accounting treatment for share-based payments. So it ensures that the company recognize a cost of giving equity, like shares or share options, to employees or third parties in exchange for goods or services. Now, the income statement must reflect that cost, and it's typically spread over the vesting period relating to those shares being issued or options. Now, there's two main types of share-based payments. So you've got equity settled, where shares or options are granted and settled in the company's own equity. Or you have cash settled, where the value of that award is linked to the share price that you're eventually paid out in cash. This can be in the form of phantom shares. So for equity settled payments, the fair value is measured at the grant date and it's not adjusted afterwards. And then for the cash settled payments, the fair value is remeasured at each reporting date until you've settled that award. As you can see from the slides, there are multiple approaches for valuing share options. And these often involve Black-Scholes models. So Black-Scholes can tend to be used for non-market-based conditions. So if you had an EBITDA target or a revenue target or an ESG target, we tend to use the Black-Scholes for that. It's a fairly simple model. Now moving on to the Monte Carlo simulation. So this would be used to capture your market-based conditions. So if I had a share price target in 3 years' time that I needed to breach in order for those options to vest, then I could simulate out those share prices to that point and recognize the expense. So moving on to, why does this matter? So IFRS 2 ensures the transparency and accountability of what could be quite a significant cost to hit the P&L. And it's especially relevant in startups or tech firms in order to incentivize management to grow with the company. Next slide, please. So we'll now look at the common pitfalls and how we avoid these in valuations. So the consequences of valuation errors extend beyond financial misstatement to potential regulatory scrutiny, erosion of investor confidence, and even, in worst case scenarios, litigation. So in the top left, we have overly optimistic cash flows. There's usually quite a lot of bias in management projections. So it's really important to assess your current performance against historical performance and industry trends. Also looking at your growth rates in your terminal value in your discounted cash flow, because that's where the majority of your value tends to sit. If you've got too punchy growth rates in there, then it could skew your valuation. Inappropriate discount rates. So if your cash flows were on a pre-tax basis and your discount rate was on a post-tax basis, you have higher cash flows on a lower discount rate, which would inflate your value. But we need to make sure that everything's on a like-for-like basis, so it should be pre-tax cash flows with a pre-tax discount rate. And it's really important to assess from a holistic perspective in terms of the cash flow adjustments. If they're fully risk adjusted, then there might not necessarily be a requirement to put a premium in your discount rate and vice versa. Inadequate documentation in valuations, it's incredibly subjective, so you need to have support for all of your assumptions, and there'll be scrutiny if there isn't that documentation. And then inconsistent applications, if the management decide to change their methodology but there's no rationale as to why they've done that, then that needs to be documented. Next slide, please. So these are the sort of questions that we feel would be relevant for an accountant to ask their clients. So positioning yourself as a value-aware advisor opens up deeper client conversations and relationships. So when you're discussing those year-end planning, ask about potential impairment triggers, such as missed forecasts or market changes. For growth-focused clients, highlight how a proper purchase price allocation process works and how you can identify those intangible assets and protect the valuable intangible assets. For a client in a working with a complex share option scheme, discuss the valuation implications early doors in order to prevent surprises at year end, and it's better from a expense forecasting perspective. And finally, always connect valuation requirements to business outcomes rather than just presenting them for a compliance exercise. Next slide, please. So these are some of the sort of case studies that we've recently worked on. These cases highlight the importance of selecting appropriate methodologies based on specific circumstances rather than defaulting to standard approaches. So we engaged with a tech startup. The challenge was to value in an internally developed software, but there was no active market for that intangible asset. So we built up a model, a multi-period excess earnings model, to isolate the cash flows directed at that asset and apply those contributory asset charges, renting those assets from elsewhere in the business to support those cash flows. We ended up with a value of 3.4 million. Which ultimately reduced the goodwill and had implications for impairment going forward. Then we did a manufacturing impairment where the client had supply chain issues or disruptions, and we wanted to convey or to challenge the recoverability of those cash flows. So we developed a probability weighted scenario for different stages of recovery, and the result was that there was actually no impairment. And then finally, we looked at a complex share option scheme, which was post-IPO. They introduced it to incentivize management to grow the company. It had market-based conditions, so we needed to capture that element in a Monte Carlo simulation to work out those payoffs. And we ended up with an accurate estimate for the expense that hit the P&L. And in each case, early engagement with a valuation specialist allows for proper planning and documentation, and avoids those 11th hour complications during the financial reporting cycles. And I hope that's given you sort of a whistle-stop tour of our services and approaches to supporting our clients.
Thanks so much. Yeah, fascinating. It always interesting how valuations work in different areas, in different contexts. There is one question coming. It's specifically comparing how easy Diane's job is as opposed to yourself. Thinking back to Gemma's points about valuation and the tax report for inheritance tax receiving less time in preparation as it's historically been scrutinised less, will that change with IHT becoming more important, basically with the impending change to business relief. This is, I don't know if you know, Gemma, the business relief is IHT. It basically more and more companies and such like Mrs. Asset can be now subject to inheritance tax. So there will definitely be a more valuations required. But I think it's going back to the question about the actual the fundamentals of what you do compared to the tax analysis and how many more people rely on what you do as such like.
Yeah, I mean, I think that's probably a bit more of a Diane question than a sort of tax valuation question rather than a financial reporting one. But I mean, I think ultimately the answer is yes. We do expect that scrutiny to increase. Yeah.
I think from their perspective, I think it's still at the end of the day, tax valuations are still, well, the valuations to put on the tax return, and then revenue will have the option to challenge it.
Yeah.
And then at the end of the day, it's just a negotiation between you and the HMRC about what is the right value. Whereas the work you do goes back to people are relying on this when they're looking at the accounts. There's much more reliance by third parties on your work. It's not just the taxpayer versus HMRC. So that was my thought on it. Sorry, questions again. Just to say, yes, slides will be made available and a recording a few days in a few days' time. No more questions for yourself. So, and if we go back to Paul's slide, Paul has managed to join us. So, are you there, Paul?
I am.
Yeah, excellent.
Yep.
I can hear, I can't see you yet, but yep. Okay, I'll over to you.
Right, good afternoon, everybody. I'm a tax partner specialising in advising entrepreneurs on their private tax matters as well as their company tax matters. So I have actually just come back from a session hosted by Rothschilds, and which a lot of other people with similar backgrounds to me were at, and the chairman there was questioning what is the future of trusts? Are trusts dead? And he was rather lamenting that, given the fact he was originally started his own life as a trust lawyer, and there's a big trust advisory community in the UK. So what we're trying to touch on here is there are changes in inheritance tax with us or about to be introduced on the 6th of April 2026 that will make trusts trickier to do. So is the trust dead, and what alternatives are available? So I think before we put the nails in the coffin of trust, I think it's worth, first of all, just reflecting why they've stood the test of time, and they have been around since kind of the Knights Templar went on their crusades. So what are the advantages? So it's very long established principles, and they provide a really flexible vehicle for collective investment by a family. And importantly, for inheritance tax purposes, the assets are not in an individual's estate. Instead, they're in the trust 10-year anniversary charge regime. Unlike companies, where companies obviously have fixed shareholders, trusts have beneficiaries, and as such, they give a great deal of flexibility and control. If your trust deed is worded correctly, you can add or exclude beneficiaries. So if one of your children becomes errant or a bankrupt or etc., you can exclude them, or if additional grandchildren come along, you can add them. And the trustees, which the settlers are usually amongst the trustees, if not the sole trustees, can control future distributions of income and capital. So in that way, life's uncertain, and trusts allow you to be able to navigate that uncertainty and flex your circumstances. Importantly, they're confidential. So trusts need to be registered with HMRC under the trust register, and of course we need to put trust tax returns in if we've got taxable income and gains, but that information is not in the public domain, and importantly it's therefore not available to the beneficiaries. So if you think knowledge that your children are going to come into a lot of money will ruin your children's lives, and some people explain it in that emotional terms, then the fact that it's in a trust rather than direct share ownership, you don't need to tell them about it. They provide asset protection in the case of divorce or bankruptcy or errant family members. And that's particularly attractive for families that don't like prenups and postnups. They're robust now, but many families just don't feel they can go there. Chargeable gains, when you put assets in a trust, you can hold them over under something called 260 holdover relief. So you can get the asset into trust without a deemed disposal at market value. And provided the asset then is within the trust, the discretionary trust, for at least 3 months, it can then be transferred out and again held over, because after 3 months the transfer out is within the scope of inheritance tax. And then finally, if I'm championing trusts, there's no double charge to tax. So if you realise a gain in a trust, you pay broadly the same capital gains tax rates as an individual would pay. But if you realise the same gain in a company, the company would pay corporation tax, which is pretty much the same as capital gains tax rates, but there'd be further tax to pay when you get that money out of the company to the ultimate shareholders through dividends, salaries, liquidation, whatever method you should choose. But they've always had disadvantages. A big one for me, because I deal with owner-managed businesses, is owner-managers are used to running companies. So they have a scepticism about trust. Simply, it's not something they are familiar with. There are additional compliance costs. You've got to do your trust tax return, your trust register, everything else. You've got those 10-year charges to inheritance tax, which compared with simply gifting an asset and surviving the 7 years, obviously you're going to pick up some of those 6% charges, which can add up if assets are in trust for a prolonged period. Income is rolled up so if you're kind of a long-term investment vehicle, income is rolled up at relatively high effective tax rates, either dividend 39.35% rate or for the 45% rate for other assets. Although when you then distribute to the beneficiary, if the beneficiary is paying at a lower rate of tax, they can recover the excess. Trust, the world is just becoming smaller and families are becoming more and more internationally mobile. And whilst trusts are recognised in kind of Anglo-Saxon jurisdictions, they don't tend to be recognised in Roman-based law jurisdictions, so you can get this complexity and difference of treatment. And then finally, you've got, and this is the big one really, that's while we're looking at other options, is entry charges to trust. So currently, you've got the settlers nil rate band of £325,000. In addition to that, you're looking usually to shelter the asset value going in through something like business relief. So up until, actually it should say 2026. So up until 6th of April 2026, you can get a lot of value into trust and get 100% business property relief on that, provided you don't then go and die for 7 years. But from that date, only the first £1 million per settler will be fully sheltered from business relief, and the rest will pick up a 20% IHT charge. And that really opened up at this question of, are trusts severely diminished in their value? So next slide, please. So many people have heard the term family investment companies, and we're seeing a big uptake. I've done many of them myself. We have done a lot around BDO, and I suppose it's a complicated sounding title, but actually they're not at heart that complicated. They're simply UK registered incorporated companies, just like any other one you might form. But I suppose the main difference is that where the company is holding assets that you would be comfortable holding personally, and hence you don't feel you need the benefits of limited liability protection that a limited company operates, you can have companies unlimited in status. So the shareholders stand by the debts of this company. And the result of that is, in most cases, those companies don't need to file information at Companies House. And as a result of that, it's therefore private. Where we do see offshore companies used as family investment companies, it's where people for inheritance tax reasons, want an asset that isn't UK situs and therefore not within the charge to UK tax for people who are not UK DOM, although, and this is a common one, those benefiting from treaty relief. So for instance, people who are Indian DOM, even if they're deemed domicile under the UK tax rules, they can leave non-UK situs assets free of UK inheritance tax on their death. So it's often the people of Indian origin who set up offshore incorporated FICs. The shares can be held by family members. You can have all the elements of article variation that you currently have. You have a bog standard company, and indeed they can be held by trusts, and often trusts are one of the or the sole shareholder of a family investment company. So like trusts, they provide a vehicle for family collective investment. So, you know, if you've got family members who aren't so au fait with the investment market and would rather just prefer to pool their money, it's a good way of doing that. And they give a low tax roll-up on income. Now, you've got a double charge to tax, as I say, potential tax at the corporate level and then further tax payable on extraction. But where you're rolling up for the long term, rather than roll up and suffer personal income tax at up to 45%, if you're rolling up dividends for most dividends, a 0% tax rate, and for other income at 25% tax rate, you can actually get very positive outcomes after 10, 20, 30 years, compared with paying your tax, if you like, as you go along at 45% rates. Next slide, please. So, what are the challenges of family investment companies? So it's the first one I guess is that further tax to pay on extraction and the double charge to tax. So in respect of income that's taxed, say rental income or chargeable gains realised in the company, you've still got to get the money out at some point in the future. And when you do so, you'll have further tax to pay if you're UK tax resident at the time. So obviously either the dividend tax rate or the family may just choose to liquidate the company and get the money out and at least then benefit from capital gains tax rates. But it does give you a higher rate of overall tax if you just drew it out in the year. The second challenge is how to retain control. Obviously, in a trust situation, you retain control by being the trustee of the trust. So how do you retain control? So we have seen family investment companies created where the mum and dad, if you like, hold shares that just carry the votes. So all the dividend rights, all the capital rights are with the next generation, but they have the votes alone. So there's an important tax case, Holt versus Holt. I think it was in Australia or New Zealand. And it said actually those votes alone, even though you can't realise the economic value through dividends or liquidation or sale, do carry an intrinsic value. If I held those and you held the rest of the shares, I basically say you're not getting your money unless you can give me a slice. So the courts decided that votes alone carry about 25% of the value of the company. But there are mechanisms by which you can still control the company despite not having a controlling shareholding through normal shareholder votes. And that's normally done by a shareholders agreement locking in your directorships and then a special class of articles to prevent the shareholders from exerting the power to the normal extent. Further challenge is any value is in the individual's estate. Obviously, if it works well, the mum and dad have given the money away for the children to invest. The growth is still in those individuals' estates, and therefore at some point will be subject to inheritance tax. So how do you protect that value for the family? You can have things like pre-nops and post-nops. I'll only give you the money to invest in the FIC if your husband or wife signs a post-nop to exclude that value from the estate that would be divvied up on divorce. You can have shareholders agreements which talk about only been able to transfer shares within bloodlines, etc. Again, that's a bit of an attempt to retain the shares in the bloodline and diminish their value. And then simply if you're a minority shareholder, again, there's an intrinsic discount in those circumstances. But that is something that needs to be considered. Next slide, please. So another thing that people are saying, well, if I can't transfer shares into trust anymore, and prenups and postnups look pretty robust. I mean, it's a legal question, not a tax question, but what general feedback we get is they are pretty robust if done properly and proper legal advice is obtained. Well, why not just do direct transfers to my children, grandchildren, or whoever? So for capital gains tax purposes, where you do a direct transfer of shares, that's a deemed disposal at market value for capital gains tax purposes, after reflecting a suitable minority discount. But in companies or groups that are substantially trading, that's an 80% test. You can do a Section 165 gift holdover election. I'm sure the vast majority of people on this call will have seen those being put in place. But one thing that keeps biting people's bums is that there's this restriction. So if you've got chargeable assets, such as an investment property, in a business, a trading business, that restricts the amount of relief available. And basically, you look at the value of those non-trading chargeable assets as a proportion of the chargeable assets. And that restricts the amount of gift relief available. And that can be very, very punitive, particularly in companies formed after 2002, where their goodwill is not a chargeable asset anymore. It's new goodwill. And then if you're transferring the asset on death, there's no disposal for capital gains tax purposes, and the donee is deemed to have acquired the shares at market value. So you get a nice tax-free uplift for capital gains tax purposes, and that applies even if the person receiving the shares is your spouse. So that was it was much muted that would go in the last budget, but it has survived. And then on the inheritance tax side, the transfer in value, and this is different to the concept for capital gains tax purposes, the transfer of value for inheritance tax purposes is the transfer in the value of the transferors and their spouses if they're married, joint estate. So for instance, if you had a 51% shareholding and you gifted away a 2% shareholding, the amount you give away can be much more than 2% of the value of the company, because there's that big drop in value associated with loss of control. So a valuation exercise is usually required in transferring shares to just work out what the exposure is. And then for inheritance tax purposes, where you transfer during lifetime, it's something called a potentially exempt transfer. So provided the person donating the shares survives 7 years, or the shares are fully covered by business relief or agricultural property relief, no IHT is payable. So the simple planning there is do it early rather than later. Next slide, please. And then growth shares. So I suppose the first question is then, what is a growth share? So a growth share is a share that only carries economic value once a hurdle has been reached. So say a company is worth £10 million, we might set the hurdle, say at I don't know, £11.5 million, 15% hurdle. So any value up to the hurdle is distributed amongst the ordinary shareholders in proportion to their shareholdings. And then in the extreme, all the value over the £11.5 million hurdle goes to the holders of the growth shares. So why are they useful in planning, and why are we seeing them increasingly used? I suppose it's a bit of a motive thing, but when the older generation simply think, well, I've worked bloody hard for this, I need it for my retirement, I'm not comfortable giving it away, but if you're taking the business over from me, you can, the next generation, I'll let you have the growth in value. Then you could give them shares that, it's over to you, next generation. you can have the growth in value, but I want to retain what I earned during my stewardship. So that's economically where we see it. We see it where people wish to incentivize senior management, and that can include family members to grow the value of the business. Again, you're saying, look, I've got it this far. I want you to work alongside me or replace me in continuing to grow the value for the business. I appreciate that you need an incentive to do so, and giving you a growth share can give you a means of doing that and a capital asset on which you could potentially pay capital gains tax rather than income tax when you cash in. And then finally, where you've seen it is where you wish to limit the potential future growth in an estate, to manage the tax or manage the tax payable on lifetime transfers. So that could be, for instance, on direct gifts, where gift relief, capital gains tax gift relief is not available or is restricted because you're not giving away much value. You're not giving out, there's not much associated gain, and therefore you're not triggering a big dry tax charge. And then secondly, on transfers to trust, and again, this will be particularly pertinent with the restrictions from the 6th of April 26 on how much you can get into trust. That fall in value of your joint estate isn't so big because you're not cutting into current value, and therefore the amount of inheritance tax payable on a transfer into trust is that much lower. Next slide. So that's me, Chris.
Questions? Right, okay. A couple of questions come up. I would say there's someone who's put their hand up. I'm afraid there's no way we can put you on audio. So if you have got a question, then please do put it in the Q&A and I'll read it out in a moment. Right, a couple of questions for you, Paul.
Okay.
I've heard a few times about it being a good idea to set up a trust to claim BPR prior to the 5th of April 2026. Is there any advantage to this compared to individuals simply gifting the shares of a trading company as holdover relief will similarly available as will BPR should the donor die within 7 years? What am I missing? So
so I suppose take those in turn. Then the direct gift, as we said, so your direct gift before the 6th of April 2026. As your person posing the question remarked there, you can hold over the gain for capital gains tax purposes.
Yep.
So that's a tip, but we need to be, if it's a substantially trading company or group, but the amount of relief may be restricted. And it's a potentially exempt transfer for IHT, therefore, provided you survive the 7 years, you're out of the window. So why wouldn't, even if you're expecting to live after the spring next year, why wouldn't you do it just to get that 7-year clock running to, actuarially maximize your opportunity to survive the 7 years? So that can be an answer for some. Why would you put shares into trust? So people are putting shares into trust ahead of the 6th of April 2026 because they can simply get more value in without an entry charge. They've still got the risk, therefore, of dying within 7 years after the 6th of April 2026, within the 7 years, and a tax and an IHT bill being due. And for that, they're looking to do life cover often. Why are people doing the trust rather than the direct issues? It's because they want to retain control.
Right.
They want flexibility.
So a lot is about personal preference rather than one being better than the other.
Yeah.
Question 2, if a trading company has a significant amount of cash on the balance sheet, putting aside potential accepted asset issues, would holdover relief for CGT be available for individual to individual transfers in full as cash isn't a chargeable asset? All the cash has arisen from trading activities, or could actually argue the company is not trading?
Yeah, so we saw, I suppose, the parallel, and you know much about this, Chris. The parallel is with entrepreneurs and business asset disposal relief, isn't it? Where the revenue basically came out and said that cash created by trading activities that then is passively held doesn't taint your ER and more recently the ADR position.
Because
and
it's not considered an activity, is it?
It's not considered an activity. So our thought is that it shouldn't stop you being substantially trading.
That sounds good. There are, I think another question's just popped up. Let me just see. if a FIC holds shares predominantly in a trading company or companies, presumably you get CGT gift relief and or BADR and IHT-BR if you transfer shares in the FIC. Is that something you considered in FIC planning? I think the answer is yes. Look at our easing from the other week.
Yes, yes. That's exactly right, Chris. Yeah, so for CGT reasons, when assessing whether you're substantially trading, you treat the group as one entity. It's all consolidated position.
Yeah.
So yes, you can have all the FICs then is a holding company of a trading group, and we can get gift relief on that. And then on the IHT perspective, it doesn't
need to be a group, doesn't it? It doesn't need to be a group. So that's where 75% holding.
Yeah, it's a nuanced difference, isn't it? On IHT, you have to look at each individual entity to see whether you qualify for business relief. But yes, I hope you can again have a FIC, or even our article talked about Chris creating a FIC, didn't it?
Yeah.
An existing trading company while you've all got those reliefs available.
Yeah, excellent. Well, I think that's it. So as I said, so thank everyone for joining us. Thank you for our guest speakers. For those, that's it for our spring program. We will be back in September with more. For TSP clients, we do have our annual conference on the 19th of June, so please do look for the invite. You should have received it. But yes, so thank you all for joining us, and have a good summer if we don't see you before then. Thank you. Bye.
Bye.